Hey everybody, welcome to the Wealth Press Weekly Wrap-Up. And today I'm here with Roger Scott. Roger, welcome.
Thank you, James.
Roger, a few interesting developments this week. The Fed has really pulled back on all of its stimulus, despite the announcement that they're actually going to start buying corporate bonds of the largest employers. So, in one respect, the stimulus of the banking system is winding down, while the stimulus of the corporate sector is sort of stepping up, which is a good thing, I think, because that's keeping more people employed, which is going to keep consumption higher. And the banks have really sort of been at the trough for several months now and have eaten their fill. In fact, they're not even taking down the overnight repos anymore. So what is the net effect of all this on the markets and the outlook for the markets going into the summer?
Well, there's definitely a shift more from Fed to corporate, and that is actually very, very positive. As you said, it's going to bring in a lot more jobs into the labor force. But what I'm seeing right now in terms of the way the market is responding to this, it's actually really interesting, and it's completely something we have never seen before. But the markets right now with this shift, they are taking a wait and see pattern. They are no longer reactive. They are now sitting on the sidelines and thinking, what's the next step going to be? The markets are not being driven by policy at all. They are still being driven 100% by fear of COVID-19. So anything that happens to the market is not going to be as representative or as manifested in its price till we see a cool off of this second wave. But people are now a little less reactive, so to say, or market participants are less reactive. We still have a lot of funds sitting on the sidelines. And typically, historically speaking, summers of the years we have elections tend to be a little more active than usual summers, because we get to see that pause in trading volume. Usually it starts up in September, October, and November, but in this case, because it's an election, we see a lot more upside, or a lot more volatility, a lot more volume, a lot more interest in the markets that tends to cool off right when the usual market cycle starts. Now, that may happen, it may not happen this year, because as we all know, everything is completely out of whack, and the market is still anticipating President Trump being reelected. And because of that, it's showing a little extra bullishness, especially in sectors that tend to benefit from the reelection. We're seeing material stocks bouncing back. We're seeing some financial stocks bouncing back. We're seeing defensive stocks starting to bounce back. And the stocks that were heavy on the premium, the stay-at-home stocks, tend to bounce back a little bit, cool off, kind of a wait-and-see pattern. And I think we're going to see that for the remainder of this month. I think we're not going to get any type of directional movement to the upside till we feel a lot warm and fuzzier about Beijing, the reinfection rate there, India, South America, and some states in the U.S. From what I understand, New Hampshire, or who was it that I spoke to somebody the other day, and they're saying, hey, just when it was Chicago, it was Illinois. Just as we were getting ready to go out, we're seeing a big spike again. So the markets, our volatility is still about double, maybe 2.5 times what it usually is, or its normal range. So we are not out of this zone yet. And I believe that till there's a vaccine, or till COVID-19 globally starts going down, we are going to be in a vulnerable stage, meaning we're going to be sitting and threading and not really showing a lot of directional bias. That's my view.
Mm-hmm. Very interesting. You know, the Trump presidential election issue is intriguing. From, we watch from outside here in Canada, yet the effect of whatever the outcome is profoundly affects our market, as it does the entire world.
Right.
So it's intriguing to me to hear that there's a general consensus that Trump will achieve re-election. It's counterintuitive in many respects, depending on where you consume your media. But the mainstream media seems to be, actively united in a campaign to create the impression that he's not going to be reelected, when that's understandable because he's no friend of the media, and the media has unfortunately started to reveal increasingly more bias, which is disturbing because that's as soon as the media demonstrates bias, it becomes less trustworthy.
Right. It becomes less objective. Like you said, it becomes less trustworthy. Exactly. Right. And that, yeah.
So with the anticipation that, there's this volatility in the marketplace, or rather liquidity, based on a growing consensus of confidence that Trump will be elected, tempered by the wait and see approach of the institutional investors, sort of puts me in a state of mind where I'm like, well, I don't really get a sense what I should do except continue my incremental exposure to precious metals, which, is a hedge against the worst case scenario in the event of reinfection and or a trade war. Though I wanted to ask you as well, we've got the meeting between Mike Pompeo and the Chinese emissary in Hawaii, which has been really played up by the media. So with all of this going on, what are you doing? That's what I want to know.
Great question. There are several things I'm doing, James. Number one, in terms of the overall stock market, with this choppy, lopsided kind of a sideways attitude and volatility high, that is a perfect recipe for iron condor spreads. Iron condor are non-directional trades. We sell premium on both sides. It's hedged, so in case there's a big fallout, we're still going to be okay. But right now, for the next month or two, iron condors is not a bad idea. Or if you're not comfortable with iron condors, bear call spreads on the S&P are not the worst idea. Momentum levels right now in the NASDAQ, in the S&P, and the broad market on the medium-term basis are the highest level we've seen in 20 years. Right now, even though the S&P 500 is now technically bullish because it's trading above the 200-day moving average, if you look at the overall momentum levels, only 41% of stocks in the S&P are trading above the 200-day moving average. So the market is long-term bearish, medium-term choppy, with a wait and see bias right now. And wow. I think it's the best way to trade this market is to look for catalyst stocks. In other words, stocks that are benefiting right now, this minute, from what is happening. Momentum stocks, stock like DocuSign, Cloudflare, things that we could take advantage right now for short term. Online retailers, no-brainers, low-hanging fruits, and again, bear call spreads, because I'm not expecting a lot of upside direction. Downside, very possible. One bad report and the market, the second shoe can fall. But bear call spreads, or if you feel a little, you can go a little wider, and iron condors, or again, ETFs that are focused on the stay at home, stocks making new highs like Chewy, stocks still benefiting from the stay at home pandemic, being very, very cautious with brick and mortar stocks. Basically taking the same approach that we took in February, because I'm going to tell you something, James. Stocks that were looking really hot before this started are still hot. I gave a buy recommendation on an e-commerce company called, ticker symbol is MELI. I gave it on April 20th. The stock has gone up 400 points since that time. Why? It was doing exceedingly well before COVID-19. It's like Amazon. It was doing great before COVID-19. It's doing great after. As long as the stocks didn't have a major impact to brick and mortar, they're not in the direct crosshairs of COVID-19. Stocks are doing amazingly well. Peloton, stocks that are thriving in this economy. DocuSign. Remember I was telling you how people are signing things, contracts are still being signed, businesses being signed. And once people start signing contracts online, hey, why do I have to go to the office? I could do this from the luxury of my own home, the safety of my own home. Or stocks like Zoom. People like this, doing things online. My wife, a perfect example. My wife I would tell her, honey, we have kids. Why don't you just order food on from the supermarket and get it delivered? No, I need to check I want to pick out my own vegetables and fruits. She's been doing that for 20 years. She hasn't gone to the supermarket in 3 months. I asked her the other day. I said, let me ask you, are you going to go back when it's over? She said, no way. So,
There you go.
yeah, so there's a fundamental shift in people's minds. And I think it would have happened regardless. It just would have taken a decade. But this COVID-19 has pushed people into doing things a certain way. And guess what? They're finding it. They're liking it. They're enjoying. James, I'm buying clothes I bought this shirt online. It's the first time I bought a shirt online.
Wow. I just ordered slippers online this morning too, Roger. Okay, so that's great then. So the Iron Condor approach and online retailers are sound. So that sounds like a pretty safe bet to me. So let's leave it there for now, Roger. And I want you to have a fantastic weekend. I appreciate your contribution as usual, and I look forward to seeing you on Monday.